from the beginning. Okay, got it. We're all good now?
Yeah. So,
Yep.
Ezra, I want to just thank you for jumping on with us today, the Drop in Area weekly Zoom. So, Ezra is the founder and CEO of JP Real Estate Funding. Ezra has been in the hard money space since 2013, having funded over 200 million in both short and long-term loans. So, definitely got some experience, and we're excited to learn from you today, Ezra. So, we'll let you take over and kind of run the meeting from here. I know you've got some slides put together for us today. So once again, thanks for joining us.
Okay, yeah, my pleasure. Thanks for having me, guys. And yeah, let's get started. All right. So first thing is this is just the way of I think I just like have everything organized. So what to expect from this talk is, obviously I'm going to promote myself, but I'm going to keep it as educational as possible. I want everyone it's going to be practical to the point and process from A to Z. So I want everyone to be able after this talk to understand exactly what exactly what you need to do in order to to first understand what is a hard money loan, how to apply for it, what's the whole process of actually obtaining and closing a loan, what's the process after. This should be, people should leave this with a lot of tools and knowledge. So that's the point of this. And also, I'm going to be talking from your point of view as you as an investor of what to expect, and also as me as a lender, what I'm kind of looking at when I'm analyzing a loan or an individual. So I'm going to kind of give you both perspectives. All right, so a little, again, intro about myself. Like what I said before, I've been in business in 2013. I actually started off with some friends who had some wealthy friends. I started investing their money in hard money loans. From there, I started a fund, and eventually I closed down that fund, and now I just have my own capital plus a combination of my capital, institutional capital. But we're growing every month, and we're on average closing around 5 million a month. Again, we have 130-year loans. I like to close on my loans in 1 to 2 weeks. I'm funding on residential, mostly 1 to 4 residential, but also 5 plus, and the loan amounts from $50,000 to $5 million. And for anyone who's there as a first-time investor that not sure if you need experience, I'm happy to work with first-time investors also to kind of walk you through the whole process. Okay, so now kind of from a lender's point of view. So when a lender's dissecting a loan to see whether they're comfortable with funding a loan or not, they're going to look at, first they'll start off with credit. So there are going to be lenders out there that are strictly asset-based lending, that meaning that they only are looking at the asset, the property itself, and nothing to do with your experience, your credit. I would say most though do have some type of either soft or hard credit pull. Right now in the industry, it's mostly been streamlined, so you'll see a lot of lenders having the same criteria. So obviously, don't hold me to this, but the average lender for a 1-year loan is going to be looking for 680 plus credit score. For a 30-year loan, they'll maybe go down to 660. When they're looking, what they're going to do is they're going to pull your credit score, and they're going to look for not only just the actual number itself, but they're going to be looking at your history. So do you have your trade lines? So do you have a credit history? Have you borrowed money before? And if so, what's your payment history? Have you been late? Do you have lates on there? Have you been paying on time? So if a lender pulls your credit and they see a nice, 680 plus score, plus you've history and you're on payment on time, then that's gold, and that's a lender's gonna love that. Kind of thinking outside the box, if you ever get into a scenario where, let's say you don't have a credit history or your credit's not great, most lenders, myself included, they'll allow you just call to bring a credit partner. So you could find someone, a family member or friend who's willing to sign on the loan with you, maybe join your LLC, or just not even join your entity, but just be willing to sign on the loan docs, and you're able to use their credit. So even if you don't have good credit, there's ways around it. Just something to discuss with your lender. The next, they're going to check your background. Again, there's asset-based lenders, but almost even those are going to check your background. They're going to want to make sure that you don't have any felonies, that you don't have any prior bankruptcies. A lot of lenders will say they'll have, let's say no bankruptcies in the last 3 years or 5 years. Every lender is slightly different. 1 second, sorry guys. And tax liens. So tax liens, from a lender's point of view, the tax liens are very bad and need to be paid off. And the reason is because tax liens technically are able to jump ahead of the lender's mortgage on the property. So it's very risky. And if you have any tax liens, the lender's going to want to make sure that those are paid off, or that you're in a payment plan and you're going to provide some type of proof. So that's kind of what a lender's looking at when they run your background in terms of experience. So again, there's certain lenders like myself also who will work with first-time investors. That's totally fine, but it would probably affect the actual amount of that they're willing to lend to you for most lenders. But if you have prior experience, let's say you're doing a rehab loan, people are definitely going to want to see that you have prior rehab experience. Again, this is something that you just have to you have to go shopping around and seeing what appetite, what are the different lenders' rules according to experience. And if you're looking for a 30-year loan, let's say you have a rental property and you want to cash out and take out money from the property, then depending on how many rentals you're currently own, and that counts as experience, you'll probably get better terms. But again, every lender is slightly different. Then there's the asset itself. So first there's location. So there's, in every market, there's different neighborhoods. So most borrowers are going to be familiar with the different neighborhoods and where the property's at. There's gonna have an appraisal. Again, not all, but a lot of lenders are going to require an appraisal. I'll get into that in a little bit more detail after, where they're gonna understand the value, as well as in terms of location. Not all lenders are nationwide. Some lenders are local to wherever they're located. Others are different states, but definitely keep in mind when you're reaching out to lender to understand where they're actually lending. Keep in mind when you're reaching out to lender to understand where they're actually lending. I think I'm on what's it called? There's an echo here. I think I'm on what's it called? Chris, do you want to mute? Do you want to mute yourself? I don't know if it's you. Chris, do you want to mute? Do you want to mute yourself?
Yes, I will.
I don't know if it's you. Chris, do you want to mute? Do you want to mute yourself?
Yes, I will.
I don't know if it's you. Chris. We're good. Okay, awesome. I wrote there LYV, but it should be LTV. So, sorry, we didn't get to asset type. So again, depending on what type of property you're going to want. There's different lenders that have different appetites for that type of property. So most lenders will divide them into 1 to 4 residential. They'll consider that one type of asset class. Then there'll be 5+ rentals. That's like 5+ multifamily. That's another type. Mixed use is another type. I can tell you that a lot of lenders, when they lend on mixed use, they're going to want to see that more than the majority of the units are residential and not commercial. And then there's commercial, which is or specialty, which is like office space and storage and other types of assets. So again, just depending on what you're looking for, each lender, what type of asset you have, each lender will have a different appetite. And okay, next one is LTV. It should be so loan to value. Each lender is going to have their different what they're comfortable lending to, the loan to value. So a lot of lenders would, let's say for 1-year loans, are going to fund up to a certain percentage of the after repair value. So for me, for example, I'm able to lend up to 70% of the after repair value. And some lenders also, there's a whole bunch of different types of LTVs. So you might hear also, I'll lend up to let's say some lenders will only lend up to 85% LTC, that's loan to cost. So up to 85% of the total cost of the project. But these are just terminologies that you should be aware of, that lenders have different types of LTV requirements. But again, I would say the majority would be anywhere between 65 to 70% of an after repair value for a 1-year loan. And on 30-year loans, 70 to 80% of the LTV, they'll value the asset. So if a property is valued at 100,000, they'll lend up to $75,000 or $80,000 at a cash out refi. Okay, so that is the asset. All right, so getting started. So now this is kind of the, how do you, I'm a first-time investor, I'm a seasoned investor, but it's my first time getting a lender. Here's what you do from A to Z. So the first step is finding the lender. So, go to Google, type in looking for a lender in Oklahoma or wherever you are, type in wherever you want and look up, see if you can find local lenders, ask around and on your RIA group here, maybe people have recommendations. And then I put my company on there also. Always welcome to reach out to get a quote from me. But if you got to find the lender, and I definitely recommend, as much as I want everyone's business, I definitely recommend shopping around and speaking to other lenders so you understand what's out there and to find the best deal that's, to find the best lender that works for you, because all lenders are slightly different. One lender might be, there might be a better choice for you. So definitely should call people and shop around. The lenders are happy to speak to you. Okay, so once you've spoken to a bunch of lenders and now you want to kind of pull the trigger, before you do, when you're talking to the lender, you want to understand the requirements. So we spoke about that kind of in the previous slide, where some questions we need to ask the lenders. You want to ask them their LTV requirements. Are you able to fund? Are you able to fund up to 70% of the after repair value? Are you able to fund? Are you restricted from loan to cost? Are you able to fund up to a percentage of the purchase and a percentage of the rehab? These are questions that you should be asking. What asset type? Are you funding 1 to 4 residential? Are you funding manufactured homes? Are you funding Airbnb properties? Whatever you're planning on doing, ask them specifically if they're funding that, because that's important to know, because you might start the process and then they might not realize, hey, this is actually a non-warranted condominium and we don't fund that, or this is actually a manufactured home and we don't fund it. So just make sure you're very clear with what you want and that they're able to fund it. I didn't add it in there, but also make sure that they're funding in that state, but they'll tell you pretty quickly. And closing time. There's a lot of lenders out there, and you might see a lender that has an interest, you might call a whole bunch of lenders and see some are all saying, hey, interest rate's going to be around 7% for a 30-year product. Then you call one lender and he says, well, actually, I'm going to be doing it at 6%. And you're like, sweet, that's great. And he might be at that 6%. But I find that a lot of times those types of lenders might take around 45 business days to close. So just ask them, also very important to ask how quickly can they close, just depending on how sensitive that is for you. But if you need to close quickly, then obviously that's something I should take into consideration. Using your lender as a tool. Okay, so I tell my clients this all the time, that we want win-win deals. We're on the same side here. If I give you a loan that I know you're going to end up losing money, I'm going to then need to go through a foreclosure process or work out some type of agreement. I don't want that. I never want to deal with that. So you and your lender are on the same side. Everyone wants to make money here. So use your, call, if you have a good lender, then you're going to be able to consult with them. So my clients, they'll go to properties and they'll give me a buzz and be like, hey, I'm in this property. Here's the address. What do you think about the comps? I'm thinking of putting the purchase price of this amount, the rehab of this amount, the after repair value, I think it's going to be this amount. What do you think? And I can kind of just give them a very high level, take a few minutes and say like, yeah, that looks good. Here's what I think the loan is going to look like. I'm going to give you a loan amount of this amount. The interest rate is going to be this, and you're going to need to have this amount of money to close. So they could already know while they're in the property, hey, yeah, I have this amount of money, check, awesome. The profit is nice. I'm gonna make this amount of money, and let's move forward. And then some also, a lot of times sellers are gonna want to see, your seller agents are gonna want to see a pre-approval letter. So again, I'm happy to do it, but whichever lender you're working with, you could always request them to send a pre-approval letter. And then you could, when you're in the property itself, you could already hand the seller, email the seller the pre-approval letter, and they like that. It's very, it shows that you're serious. All right. Okay, so now now kind of moving forward, next steps. You found your lender, you've located them, you're in touch with them, you're in good terms, you know what they want, and now you're looking for that property that you want to buy, or you want to refinance it, whatever it is. So every lender is slightly different. Some will make you fill in some application online. Others will, like myself, will just say, hey, just let me know if you want to move forward. So I just have my clients will say, hey, yeah, I like the terms that you sent me. Let's do it. Let's move forward. And this could be done pre or post under contract. So even if you don't have the property under contract, you could still start it. You could still start the process if you want, or you can wait till the property's under contract. At that point, the lender's going to send you a term sheet. The term sheet should include the terms of the loan, the interest rate, the loan amount, if there's rehab, how much is being held back, and also the list of items that you're going to need. So they'll send you the exact list. I'm going to go through that list after of what most lenders are going to ask for. But they'll send you the list so you know exactly what, and that's why actually probably for the first time, it's probably best to actually do it before you put the property under contract so you get a better idea, or you can even ask the lender, hey, send me a sample of what I'm going to need. And that way you get an idea if you have that information, if it's going to be an issue, and that's important. Okay, upfront fees. So most lenders are going to require some type of upfront fee, not all, but I would say the majority. And it's going to be for paying appraisals. There's something called, you could do a desk review or appraisal desk review. And again, I put there, it's generally depending on what the lender requirements are, it's between $350 to $700. So that is normal. And my policy is I use local appraisers, and I don't like taking anyone's money at all. So I say you speak to the vendor and pay the appraiser directly. Some lenders will say send us the money and we'll deal with it. But I would definitely recommend using lenders that you pay the money directly to the vendors and not the other way around, and not to the lender. Application fees. There will be lenders that will say, hey, just send us like $800 up front, and some will say if we don't close, we'll return it, but some will say it's just the processing fee. If some lender's asking you for money up front before they fund the loan, do not go with them. There's so many. First, it could be a scam. Not saying that all are, but it could be a scam. And if it's not a scam, it's not worth it. There are other lenders out there that will not require for you to send them any upfront fee. So just don't do it. Go and find another lender that'll, that won't require that. Okay, so you got the property under contract, you want to move forward, they'll send you the list of items that they need. Again, every lender's different. This is kind of what I'm going to require, and I would say most lenders are similar to this. So for myself, I'm going to require a credit report. That's something that me as the lender pulls. You're not charged for that. It's my cost. I'm going to run a background check on you. A PFS is a personal financial statement. Every lender, again, is slightly different. I just have a form that you fill out. It's something that I just for me, it's just a box I need to check. So it's very straightforward form, and I'm not technically actually verifying any of it, but you just fill out this one pager with your how much money you have, how much your liabilities are, and you send that in. Bank statements. For most lenders, for 1-year loans don't require it. For 30-year loans, most lenders will require to see 2 or 3 months worth of bank statements. And what they're looking for in the bank statement is, if it's a purchase, they're going to see that you have money for the down payment. And if it's a refinance, they're going to want to see that you have anywhere between 3 to 9 months worth of interest and principal payments in the account. That's typically what they're looking for in bank statements. Experience, if it's a rehab loan, if you have the experience, they're gonna send you some type of PDF that you could fill out with your prior experience. And if it's a 30-year loan, they'll want to see past rentals that you have. Entity docs. So not all lenders require this. As some lenders will say that they could fund to an individual. I myself, and I would say a majority of lenders require that you have to own the property in an entity, which is either an LLC or a corporation. And the entity docs that the lender is going to want to see are the articles of organization, the operating agreement, the EIN, and the certificate of good standing. If I was going to say if anyone has any questions after, they could ask me, but basically these are very standard, and you could speak to the lender and they'll explain you everything with it. It's not difficult. Purchase contract. If it's a purchase, obviously they want to see a signed purchase contract. Payoff. If you already own the property and there's an existing lien, most lenders will say that they won't allow any first or second position, so you'll have to provide a payoff so they know how much to take out that first position, other loan that's already on the property. SOWs is scope of work. So if it's a rehab, the lender's going to want to see a line by line budget of how much how much each item is, and what the cost is. So each item and the cost, the appraisal. Again, some lenders will just order appraisal internally. Some use companies called AMCs, which are nationwide appraisal companies. I personally am not a fan of those. I like using local appraisers in the area, but again, every company is slightly different. So just when you're vetting your lenders, just ask them what the appraisal process is going to look like, and that's also important because my appraisers, let's say, will turn around appraisal for me in 3 to 5 days, and others might take like 2 weeks. So again, if it's a time-sensitive thing, definitely ask about the appraisal and how long it will take and the cost. And property insurance. Every lender is going to want to make sure that they have property insurance. They're going to want to have the lender's name added to the insurance policy, and I know myself, I am just in touch directly with your insurance agent, whoever you want to use, and we'll let them know what I need. And I also work with some insurance companies that I can help provide quotes for if you ever need. Okay, so now closing.
Hey, Ezra,
yeah.
real quick, while you're right here switching the slide, I kind of help keep an eye on the chat here. We've got a couple questions, if you don't mind addressing them real quick as you're going here.
Yeah, of course.
So we had Chris ask, do you recommend putting a property under contract before approaching a lender?
Definitely approach I would have the lender ready first before you put the property under contract. Again, all of my clients will call me before they have the property in contract, because you want to be able to use your lender to kind of run bounce the property off of them under, see what their take is on it. So definitely have the lender, or have multiple lenders that you want to work with beforehand.
Okay, sounds great. And a second question real quick is, are you looking for a replacement cost insurance policy or an actual cash value policy? Is that fine?
Again, every lender's different, but replacement costs typically
is okay. All right, perfect.
Yeah.
All right.
Okay, great. So now turnaround time. So again, I think that from what I'm seeing out there, there's the quickest that you'll have very local, maybe lenders that don't require appraisals that could turn around a loan in like a few days. I would say on average, people are taking between 2 to 3 weeks. I'm personally taking 1 to 2 weeks to close a loan, which is from from when we start the process until you get your money. But again, just call your lender and understand, but just so you guys know what's out there, what the average times are. The title company. Title company is very important. They're the ones first making sure that the properties, if you're buying a property, that the seller indeed is truly the owner, and that you're getting 100%, you're going to be the owner once you buy the property. It's very important. Again, title company, if you're buying it, a lot of times the seller will choose it. You could choose it. Some lenders will require that they use their title company. My policy itself is whichever title company you want to use, I'm happy to use. And then once you send in all the underwriting items and the lender says, hey, we're good to close, I would say on average, it's around 1 to 2 days for the title company to actually close a loan and for you to get the property or to refinance, get your cash out, whatever the case is. Okay, so, there we go, post-closing. Okay, so now you've funded either you have a 1-year loan because you're buying a property or with rehab, or you have a 30-year loan because you're buying a turnkey property or refinancing or cashing out. But now you have the loan, and now the next step, so interest payment. So if it's a 1-year loan, most lenders are charging interest only payments. So you're not paying any principal, strictly the interest. Majority lenders are using a third-party loan servicing company, where whatever that third party, so you're not paying the lender directly, you're paying another company that's collecting the money on their behalf. So at the time of closing, either the lender will require you to sign some type of agreement where you have an ACH already set up that the money's automatically taken from your account, or you might get a letter from the loan servicing company or an email from them, kind of a welcome letter explaining that they're collecting the interest, and then you could either call them up and set up an ACH then, or you could just pay them every month via on the phone or check or wire. That's something that you should, again, speak to your lender about prior to closing, and make sure to be proactive and make sure that your interest payments are being paid on time. Because it could be that for whatever reason, the loan servicing company had the wrong email, they didn't send you the welcome package. Don't just assume that because you didn't get an interest payment invoice, you don't have to make it. So if for whatever reason the lender does drop the ball, definitely be proactive, because you don't want to incur default rates. Every lender will have a default rate jumping from whatever their rate was to like 20-something%. So definitely be very proactive with your interest rates. If for whatever reason you can't make your payment, speak to your lender. Again, I know for myself that if someone comes to me and says, hey, I'm having issues, I will waive their late fees or their default rate and just give them a little bit more time. So definitely I would say communication is key. That's the last point there. But yeah, that's your interest payment. Draw request. If it's a rehab loan, every lender is slightly different. I'm just going to tell you how my process works. Is I hold back 100% of the rehab. So if it was $100,000 worth of rehab, I held $100,000 back. I'm then going to release it to you as you complete the work. So that's also important when you calculate kind of how much money you need to have prior, to set aside for this loan. Keep in mind, it's not just the money you need to bring to closing. You need to also advance some of the rehab. So if you want to do, let's say, $10,000 or $20,000 draws, you need to make sure that you have $10,000, $20,000 ready to go to start the draw process. For me, I tell my clients, be in touch with me 72 hours before the work is done, before you want to be reimbursed. I'll then order already a draw. I'll send to know where to wire. I'm going to send you a DocuSign, and then you can input your wire information, your bank information, so I know where to send the wire. I'm also going to then send you a link, which you can then take your own pictures and upload the pictures of the work that you completed. And once that's done, then the wire is released 24 to 48 hours after. I'm charging $250 per draw. I have a third-party company that reviews it and provides me an inspection report, which I then share with you after. But that's another fee that you should keep in mind. And when you speak to a lender, ask them how much how much the draw fee is, if there is one, and also how quickly they'll release the wire, because some lenders might take 5 to 7 days to release the draw. So it's just very important. Payoff. Okay, so payoff is, actually, before we get to that, back to the draw, some lenders might charge you interest on the entire amount, even on the amount that you don't draw upon. And but I would definitely try and request to say, hey, I don't want, make it, I think it's called not Dutch interest, where you basically only get charged interest on the amount that you've drawn. So if you have $100,000 draw at the time of closing, you don't want to be charged interest on the $100,000 until you start using it. So that's also another important thing to speak to your lender about. Okay, so payoff. So now you've finished the rehab and you want to flip the property, or you have a 30-year refinance loan or purchase loan, and the interest rates went down and you go to a local bank. So you could either call up, tell your lender, hey, I want a payoff, and you'll send that payoff to whoever your new lender is, to the title company, and then they'll take out the lender's loan, and That's basically that step. So you either speak to your lender or you can request it from the loan servicing company, and they'll provide a payoff or whenever you anticipate you to pay off that loan. Extensions. So let's say it's extensions mostly apply for 1-year loans. Let's say I have a client right now in Chicago where they have it's terrible there and it took them 9 months to get a permit. So now they require an extension. So again, these are one of these things when you speak to the lender, when you're vetting lenders, ask them what their extension policy is. Mine personally is I allow for 3-month extensions, so it's an extra 9 months after the 12 months, but each extension is going to cost you 1%, like 1 point extension fee. So again, that's something just to speak to your lender and understand what what their policy is. I'm going to just jumping back here. I forgot to add, which is important for 1-year loans and 30-year loans, is prepayment penalties. I'm just going to jump back to that. I'm sorry, missed it. Some lenders for 1-year loans are going to say, hey, there's a 3-month or 6-month prepayment penalty, meaning that if you bought a property to flip and you flip the property in 4 months, they're going to still make you pay 6 months worth of interest. So that's also something to ask. Again, my company doesn't have any prepayments on my 1-year loan. So you can flip a property in 2 months and not pay interest. So, and only pay interest on this 2 months. So just make sure you speak to ask your lender about that. And for 30-year loans, I've seen 1, 3, 4, and 5-year prepayment penalties. So every lender's different. So just ask so if you're getting a 30-year cash out with the intention of refinancing once the interest rates come down in 2-3 years, but you still might have to pay a prepayment because you had a 5-year prepayment option, penalty on there. So again, just some of these things to keep in mind when you're speaking to lenders and discussing options. Okay, what did I say? Sorry, I went all over the place. Extensions we spoke about. Communication, again, communication is key. If something happened in the rehab project where the budget changed, or you're not able to make interest payments, I can't promise that every single time or every lender is going to be flexible, but it definitely can't hurt. Regardless, if you're late on your interest, regardless, you're going to be paying those high default rates. So it can't hurt. Just be upfront, speak to your lender, they'll respect that, and if they are able to be flexible, they will wherever they can. And yeah, that's it. So that's kind of the process from A to Z. How to find the lender, find your property, and close the loan, and what you do afterwards. I hope that was educational, helpful, and you guys took a lot out of it, and make your life a little easier when next time a little less scary when you're looking for a hard money loan.
That's great information, Ezra. We got a couple questions that popped in. I'm going to let them ask it. Levi and then Chris had a question. So Levi, you can jump on first there.
Yeah. Do you do any second position loans or any gap funding? Great
question. I personally do not. And yeah, just for everyone, second liens are people that so there's already a first loan on the property, a mortgage, and someone wants a second. That also, a lot of times people will come to me and ask if the seller will do a seller holdback. So when you're buying the property from the seller, they might say, hey, I'm going to keep a loan on this, and that way the purchase price will be slightly less. But again, that's similar, and I don't do that either. So, but there definitely are lenders. Again, just go to Google and type in gap funding, and or I think I have someone that could be able to recommend. That I've never used them, but I know that they exist. If you want to speak to me after.
Okay.
Awesome. In lines of credit, whether that be secured or unsecured, do you offer anything like that?
Yeah, another great question. I do not do any line of credit. It's just specific on the one property. You get the money. If it's a refinance, just take out all the money at once, and I don't have any line of credit options.
Okay. Okay.
So something that popped in my head is, I know that you had mentioned that, and this is just a question, it's not a criticism, but you said that your guys' policies, you do 70% loan onto ARV. And you ever run any issues with that where people are like, because you feel like sometimes you go to bank and get an 80, but you guys are doing 70. So what are your thoughts on that?
As in are banks doing for rehab loans? They're doing 80% ARV.
Yeah. So if you're going to go either side of that, you can go 80, and I get why you guys are doing that. That's smart, to do only
Right.
70% ARV. It keeps you guys really safe. But I just didn't know if that was ever a pain point for you guys to losing potential clients just because it's at
No,
70.
I think if people, especially for 1-year rehab loans, I definitely would lose business on 30-year loans because you get a lower rate if people are willing to kind of jump through a little bit more hoops and take the 30 to 60 days to close a loan. Then definitely, I can't compete with a bank. Go to a bank by all means. But for the 1-year loans, I haven't seen that. Like at least the local banks. I haven't lost anything to local banks, let's say for the 70%. Most clients
Sure.
also are within the 70% after repair value anyways.
Right.
Good deal.
Mhm.
In what states do you lend?
No, go ahead, Chris.
Yeah, I'm nationwide, except for North, South Dakota, and Minnesota.
Okay.
So, yeah. So I'm pretty much, and I've got my group of local appraisers in every city. So, we're good. I have a whole bunch. So whenever someone comes to me, I'll have the ones I always work with, but I always just send out an email blast to get a quote and turnaround time so I can get the best, the best quote for the client.
Great. Ezra, just a quick question, and you might already cover this, and I'm sorry if I missed it, but do you charge any points on the front side or any origination fees?
Great, yeah, great question. Well, my 1-year loan is 11%, 2 points. That's what my 1-year loan is. My business model is I'm just charging the least I can make so I could do volume. So even if you've done a lot of loans, you've done experience, that's kind of where I'm at for both first time and seasoned investors. I just try doing the best that I can. And on 30-year loans, that's very dependent on the debt service income ratio, the loan to value, experience, credit. I would say on average right now, the loans that I'm writing are in the 7% range, mid to high sevens, and 2 points as well. That's 30-year loans.
All right.
Again, by
And
all
the only
means, everyone should go shopping and find whatever's the best for them.
And then, Ezra, the only question I have, and it wasn't specific about you and your company on lending, but I want to know if it's common. So rehab money, you're holding it and doing draws. You said you just charge a $250 fee every time you do a draw on there. I don't know if I've just never heard of that before. Is that something common, even if you're going to a bank, or because it just seems like it's cash gone?
Yeah. It's definitely something. Listen, it's one of those things where you build it into your profit. So just keep that in mind. For me, you can have as many or as few draws as you want. Again, this business right now, the hard money business has been very streamlined. So I would say yes, a majority of the lenders are doing that. And the reason why is because when I started this in 2013, most of the hard money lenders were just using private capital, their own capital, investors' money, or private funds. What's happened now is there's very large insurance companies and hedge funds that this is kind of on the back end. What you guys don't see is that what the business model for most lenders, myself included, is you'll fund the loans with your own capital, and then afterward you'll still service it. So you're going to still be the one in touch with your client and everything, but these loans will be sold off. Almost, I can't even think of any lender right now. They're holding on to their own loans. They sell them off, and then those loans are then being bought up by these insurance companies and hedge funds. So because that's the case, they have certain standards. So those are, you require these types of specific inspection companies in order for them to be able to buy these types of loans. So that's why I would say majority do require this now. Again, it could be that there's a local lender that might not require it because he's just strictly using his own funds and not selling the loans, and that could be the case. But again, definitely call around and call other lenders and find out and see.
Okay, that's great information. Thank you for that.
Yeah, my pleasure.
All right, who else has any questions?
Where are you located at?
Currently, Toronto.
Gotcha.
Yeah.
Yeah, I know a lot of the information you're given is probably pretty accurate, as far as nationwide and larger metropolitan areas. But for this area, I don't know. We see a lot of portfolio, small banks and stuff that'll do quite contrary to some of the things that you're mentioning here. But
That very well could be. No, I'm not familiar with all the. I can tell you, I do a lot of. I was based out of Pittsburgh for a while, and so I can tell you kind of what's happening. I'm basing off at least the local banks in the Pittsburgh, Pennsylvania area. But I don't, it very well could be. And if you guys are better, again, I always tell my like I really just try doing the best that I can of just being very transparent and giving quotes very quickly. And it's one of those things where it's like, hey, this is what I could do. This is my best rate. If you like it, awesome. Let's move forward. I'll close quickly for you. If not, no worries. Go to the local bank. Totally fine.
yeah, your rates, I mean, what you were quoting rate wise, that's very competitive with what we're getting here. It seems like. Do you guys have any like minimum loans that you're minimum value that you're going to be even look at?
Yeah, awesome. Great one. Again, great question. So for me, my 1-year loan product is minimum loan amount is $50,000. That includes purchase and rehab together, part of the loan. So 50,000 is my minimum for 1 year, and for 30-year loan, my minimum is 75,000. I would say for across the board, you'll see at 1 year, most people are 75K. So in 1 year, I could go a little bit lower, and on 30-year, I would say it's between 75 to 100,000 is the minimum for most lenders.
So the flip side of that, what's your maximum?
5 million. I'm most of my loans that I'm funding right now are in Chicago, Cleveland, Pittsburgh, Indianapolis. Where in those areas, as in most of my average loan size in Cleveland is like $75,000, and in Chicago maybe a few hundred. But I'm not getting anywhere between. I give up to 5 million, but I'm not getting anywhere close to that. I wish. Guys, send me some $5 million loan request, please.
Well, if there were some carryback situations and stuff like that, that'd be pretty easy. But I know earlier you said that's not an option. So
No, sorry. So we'll
Hey,
settle at
Ezra.
2 million.
And so just
Yeah.
for curiosity, because we're also what you're telling us about, it's also an opportunity for us to ask you questions, not to criticize you for your terms and stuff like that. It's also you're teaching us about the back side of your side of the desk. So it's really helpful. So whenever it's a carryback situation like that, let's say it's $1 million loan and there's a carryback on it, where's the risk for that on the lender? Because isn't it still going to shake out for you on if you're going to go 75% ARV or 70% ARV? Isn't it still safe for you?
It's we'd be looking at it as the kind of the term of skin in the game. Like we want to make sure that the borrower themselves have some risk. So if we're in a situation where the seller's holding back 30% and I'm funding 70%, and you're bringing $0 and you've no risk in this. So we want to see that you kind of feel some pain also if for whatever reason the deal goes south. That kind of
Sure.
keeps our interest aligned.
Sure, that makes sense.
Mm-hmm.
You might have covered this also, but what is your down requirements for somebody on a loan?
Like what?
Sorry, down payment.
Down payment. So for 1 year loans, for me personally, how it works is if you have no experience, then I'm going to want you to bring 30% purchase price. So I'm going to fund 70% purchase, 100% rehab. If you've done one rehab, I'll go up to 75% purchase, 100% rehab. For 3, I'll be at 80% purchase, 100% rehab. And if you've done 5 or more, I'll be at 85% purchase and 100% rehab. So best case scenario for you is if you have the experience, and I'll fund you'll have to bring 15% of the purchase price, plus title and points and those closing costs. And for a 30-year loan, if you're buying a turnkey property, you could fund, depending on your credit, I want to see at least 720 plus credit to get you to the maximum, which would be 80% purchase. So you'd be bringing 20% of the purchase price for a 30-year turnkey property.
All right, great.
And what's your origination points?
2 points on both 1 and 30-year loans.
And your 30-year, you're still looking for the 70%, right?
No, for 30-year, if it's a purchase, I'll fund up to 80% of the purchase price. If it's a refinance, then there's something, here's some terminology here. There's cash out refi and rate and term. Cash out refi is when you're actually walking away with money or cashing out money.
Right.
I'm able, for that scenario, I'm able to fund up to, depending on credit and debt service income ratio, but best case scenario, I'll cash you out up to 75% of the as is value. Something to ask for when you're refinancing a loan is seasoning requirements.
Mhm.
My seasoning requirement is I need you to have owned the property for 3 months. So
Okay.
after 3 months, I'll be able to fund up to 75% of the asset's value. And rate and term, meaning that, let's say the payoff is the other loan on there is very high, so you're kind of breaking even, or you even have to bring money to closing. I could fund up to 80% of the value of the property.
Now
And
that, Ezra, is a huge selling point for you. Is
Oh, yeah.
you only got 3 months seasoning, where government just switched to 12 months, which is a big deal for some folks. So
Oh yeah, yeah, definitely. Again, I'm not. And what are the bank rates right now? Like 6.5%, 6% there. What are they charging you?
Yeah.
six
Okay,
five,
so
6.8-ish.
Yeah. 6,
okay,
6.
so
Yeah.
I'm like a percent higher. But yeah, again, I could get you out in 3 months.
Ezra, when a new investor is coming to you, and what are you looking for as far as experience? So what could they bring to you or build for you that would help you in a decision with a newer, I won't say a new investor, but a very, very inexperienced? What kind of information are you looking for? Past projects? What's something that would be really nice to see?
Yeah, so again, if I don't mind work, I have a lot of new first-time investors, and I'm happy to help people, to hold people's hands and walk them through the process, kind of like what I did, or kind of explain this right now. I'm happy to do that on an individual basis. So I just, my goal always is just to kind of get people the information, just dependent on what their experience is. So when someone calls me for the first time and they say, hey, I want to buy this property, I'm just going to go through them very quickly. I'm going to be like, hey, well, how many rehabs have you done? I'm not verifying anything. I'm just taking it on their word. Afterwards, I'll do my underwriting to kind of find that, to make sure that they're telling the truth. But I'll also ask, hey, what do you think your credit score is? What's the rehab? How many past rentals how many past rehabs have you done? What's the purchase rehab after pair value and address? And based off that, I'm just going to email them while I'm on the phone with them. Here's what the loan amount is based off the information you said. If afterwards, if I find out that you told me you had 5 rehabs that are flips that you did, but really you didn't, then the terms will change slightly. But again, it's just, you just kind of be upfront with me and transparent, tell me what you have, and based off that, I'll let you know what the loan is.
Okay.
And then afterwards, we could get into the nitty gritty, to the weeds. But yeah, just a phone call, just very easy, just run through the scenario. I also have, if you want, I could send it after I have my a 1-pager snapshot. It's an intake form. It's really easy to fill out. And I have one for, for 1-year purchases, for 30-year refi, 30-year purchase, new construction, all different scenarios. Just whatever your request is, you fill it out, you send it back, and that's the high level information I'm going to need in order to structure the loan.
Okay. Nice. Yeah, we'd love for you to send it over.
Okay, I'll share it to you, Chris, after. You could just send it to the group.
Are you doing all your own underwriting, or are you using like local appraisers for everything you're doing, hard money and
So
long
in terms of the appraisals, yes, everything is, I'm not an appraiser. I don't claim to be an appraiser. I always use local appraisers. In terms of everything else, I'm doing the underwriting. So I'm reviewing your bank statements. As in I have a team also, but we're reviewing all those if you go back to the underwriting slide, it'll have it all there in there, but I'm reviewing that all. It's all done in-house.
So on your 1-year stuff, are you sending appraisers out then before you'll do your business? When you're saying you're funding in 1 to 2 weeks, so you getting all that done ahead, in that time frame, or?
Yeah, that's all. The 1 to 2 weeks is from when you say, hey, I want to move, when I want to move forward, and I send out my term sheet with all the list of items I need. From that time to when we close is generally 1.5 weeks, 2 weeks, because in that time I have the appraisers who are going to go out, check the property. But let's say it takes them day one, you say, I want to move forward. We call the appraiser, he schedules the appraisal of best case, let's say in day 2 or day 3, then it takes another 5 days to get the appraisal back. So we're already on day 8. At that time, hopefully by day 8, you would have sent me all the rest of the items that I needed. Then it takes me around a day or so to review and approve the loan. That's day 9. And then goes to my attorney. My attorney's in touch with the title company, and that's another, let's say, 2 to 3 days to close. So that's day 12. So, that's your 12 days. Let's say that's kind of how I'm calculating that.
I want to meet some of your appraisers that can get out that fast.
Mm-hmm.
So to be true, to be honest with you guys, obviously I do have like appraisers in your area. I haven't used them there, but you're right. In certain areas, there might be appraisers that might take a week and a half, whatever. But I'm funding, again, most of my loans that I'm funding are in New Jersey, different cities in New Jersey, Pittsburgh, Cleveland, and Indianapolis. I speak a lot in the different RIAs in those areas also. But I have appraisers that I've used so many times that they'll just, send the report back in 2 days. And that's also a big difference between I don't use these AMCs. When you have another third-party company that has to find the appraiser, review it and everything, then they'll take a week, 2 weeks to close it. Or if you're using a local bank, for sure, 2 to 3 weeks. But if I'm the one be like, hey, hey, John, get me the appraisal, and then I'm calling him every day to make sure that he sends it to me, then I get it done, then I get it back pretty quickly.
I can't even get local banks to answer my emails here recently. So
Right.
Yeah, so that's definitely the difference. I'm not a local bank. You'll have my cell phone number. I'm answering. You can text, call, email. I'm very, very quick in responding, and you'll hear back from me. If I don't answer, I'll call you back right after. So definitely the difference. You'll have someone to speak to.
Awesome.
Okay.
Yeah. We appreciate your time. Any other questions while we have Ezra on the call? Okay.
Awesome.
Yeah.
All right, well, thank you guys so much for having me.
Yeah,
It
thanks
really was
for-
a pleasure.
Thank you.
Thanks for joining us. And Ezra, do you offer a referral program?
Yeah,
Anything like that?
Yeah, wonderful question.
Yeah. Just thought of that.
I do. How that works is typically a broker, or even if you're not a broker, you don't have a broker license, you should be anyone who refers me someone. What I always tell them is, first, if you want to refer me to someone, introduce me via email. Don't just give my name out, because that way I might not know that they might not say that it was from you, and then I won't know to pay you. And what people referral fees, it just depends on what you tell me, but typically people are saying I want to be charged 1 to 2% of the loan amount. And you just need to notify me in advance. And then when I structure the loan for that client that you introduced me to, I build in your referral fee in there. So they'll already see it in there as your 1% of the loan amount broker fee, it'll say. And then once we actually close the loan, you'll appear on the closing statement on the HUD, and the title company will pay you your money once the loan actually funds. So that's how that's how kind of a referral fee works.
Okay. Okay. Well, thank you again.
Yeah, thank you guys. So Chris, I'll forward over the snapshots, and if you want to pass around my information, that'd be great.
We'll do. And don't forget, our RIA meetup is next Tuesday at 6 p.m. at Old Chicago. So we're going to talk about people leaving their W-2s. Andrew Moore will be our presenter. So yeah.
Hey, Chris and Levi, can you guys hang on after the call?
Yeah.
Yes. Thank you, guys.
All right. Thanks, everyone.
Thank you.
Appreciate it.
Take care. Bye.